internationally. Let me start again. Good evening. Thank you all for joining us from wherever you are based internationally, either as a female or male founders. We have a great panelist today that we have chosen to take women for boards, particularly for this session, with various backgrounds and experiences, and they will obviously introduce themselves. I would like to point out that this is the recorded video so that we can share afterwards with our network. But we would like to encourage everyone to have the cameras on. It is most personal and dynamic if we do have cameras on. So I would be grateful if you can. I will be also letting you know that very soon we are coming out with our offering to Tech Women for Boards for the founders, where we are going to actually tackle their pain points on the topic of matrix, money, and mastery. So if anyone is interested in that webinar, please do email. I will put in the chat box later, Maya, for the inquiry. I won't be talking much longer because you have a lot of content to cover. Please do connect. We always encourage our network to network and connect. And please do submit your questions in the chat box. And at the end of the session, panelists will be trying to answer. I hope we'll have enough time. Thank you so much. I will pass the microphone to Mariana. Thank you, Mariana, for moderating, and thank you all the speakers for your time.
Thank you, Zana. And thank you all for joining this call. And I would like first to give you a very short overview of our panelists, because you have a chance to hear an amazing panel of very experienced investors from different regions and from different investment models. So we have an honor to hear two ladies, which are VCs in London. So it is Lisa and Mera. And then we have a chance to hear another VC, which is from Dubai. This is Dr. Dominic. And we will also have the opportunity to hear from Zurich, our angel investor, who will give you a perspective from the angel investor, and that is Dr. Damian Zek. So thank you all for joining this panel and for being willing to be grilled as an investor. This is really a rare opportunity, and it's really great to hear different angles from different regions and from different investment perspectives. So let's start with a question. We try to incorporate all the questions which you sent us. Thank you very much for being proactive. And first we will start with a very important topic, actually. When is startup really investor ready? So for that part, we need, let's say, a few very important topics to discuss. And first is how to define readiness from the investor's perspective. And I would like to start first with the angel investor. And I would like to hear first, what do you think, Damian?
Yeah, thank you very much for this question. Actually, yeah, as an angel investor, I'm probably the person who gets first in touch with startups and startup ideas. And thinking about when is a startup ready to talk to an angel investor, is what comes to mind is basically the startup needs to understand the business. What is the business model they want to achieve? It's not about the product, the service. People love to develop products, to develop services. As an angel investor, I'm not so much interested in that. I still am, but more important is to understand what is the business model they want to achieve. What is the business they want to build? Next important topic is the team. What is the team who is pitching? Do they bring the relevant experience, expertise that they actually can build a business, not develop a product, but build a business? And lastly, what is important is, do they have the relevant market experience in terms of, do they understand in which market they are? They compete with. Do they understand what is the client demand? Do they understand what is the market size? So in essence, do they have a helicopter view on the business they want to build? And if they do have that or believe they have that, that's the point when they should start talking to an angel investor. So that's my view as an angel investor. I'm sure that a VC, they have similar perspectives and probably even broader and more deeper expertise which they require before they talk to a startup.
Thank you very much. This is really great summary. I would like to ask the same question to our VCs. So let's speak, for example, with Lisa. So how would you define readiness from the, let's say, VC investor perspective? Is there some difference from what we heard from Damian or not?
So I totally agree with Damien, and I would start actually taking a step back and say, is your business appropriate to be funded by a VC? And a few questions I would ask to kind of answer that question would be, is it capital light? So for example, a software business. Can it scale fast and cost efficiently? And does it have a very large market to go for? There are other questions you could ask, but those are would be the key starting questions. Is this venture backable? Or is it a different kind of business which needs different kind of funding, and you could go a different route? If you have that shape of business that is appropriate to VC funding, then I would definitely agree with Damien's initial thoughts, and business models absolutely critical. But I think I would look at the product or service, but make sure that the founder can articulate what it is in a clear and simple way that anyone can understand. Then to look at how differentiated it is, how defensible it is. Can someone copy it quite easily? Or is there something proprietary about it where you can really hold on to the value and scale the value? Similar to Damien's point, what is a credible estimate of the market size, and how do you define the market? So, you could define the market so large that it becomes meaningless, or so small that it doesn't feel big enough and valuable enough to run at. Crucially, who are your target customers? Why are they going to buy this? What's their pain point that this addresses? And what are they willing to pay for this solution? And where have you got the evidence to demonstrate this? And then, as Damien said, team is absolutely critical, particularly at the early stage, when team is maybe the only thing that you can put in front of an investor. So I totally agree with what he said about the credibility of the team, their knowledge of the market, but also how is your role scoped? What are you responsible for? What's your co-founder responsible for? What's your team responsible for? And finally, what are you going to use the funding to achieve? How are you going to de-risk your business proposition with this round of funding?
Thank you very much. This is a really detailed answer. I like it. And since we are here more focused on female founders and how we can support them, I think it would be very important already at this point to really stress what is the, let's say, gender lens, and to look at the how women are behaving when they are coming to investors, and are they often over prepared, and what ready really means. And for that, I would like to invite Dr. Dominic to give us his opinion, because he worked with a lot of different startups, and especially women.
Yeah, well, thank you very much, first of all, for having me. It's an honor and a privilege. I'm talking to you from Dubai, so it's getting a bit late here.
Thank you
regarding
for joining, really.
Real pleasure. Thank you. No, regarding the gender, of course, it's a pity that it's a male who has to talk about it. I'm joking. The one thing I would always recommend is beware of analysis paralysis. compared to men, basically women tend to, and I'm maybe generalizing, but tend to be too much of a perfectionist. They fall for the over preparation trap. And it's important that we actually redefine what it is to be ready, meaning ready means validated. It doesn't mean flawless. So what's different with males is that they actually tend to fundraise earlier because they will test the market whilst they're actually iterating. Whereas women tend to be a bit more cautious and take more time. I've always been taught the better is the enemy of the good. So again, go for it, try and test it. But there are a few things before you define readiness. The one thing is your problem and solution, which actually goes from problem to assessing the pain, the need, and the solution has to be validated by real users. That, as an investor, I would be looking for. You have to demonstrate traction. And as Lisa said, and Damien, crystal clear conviction needs to be communicated across, not completeness. We don't expect that from you because you still have to test. You have to show that you have feedback loops in place so that you can act and react fast. And don't start talking about a product market fit. Think in terms of problems solution fit. So it's all about proof of progress and your capacity to execute. And that to me, that's important. And so the recommendation I have is go for it. Perfection is a delay mechanism. It's a form of procrastination, right? It's theory. As an investor, I don't expect certainty. What I want is clarity. Okay, traction beats theory. And I get inspired when your vision is backed by data. And I leave it at that for now. Thank you very much.
Thank you very much. Thank you. This is really greatly said. I will have to take some notes afterwards and make it as a highlight of the event. Thank you a lot. Now I think what is very important when we heard quite detailed answer, what's mean to be investor ready, then we are coming to the next point. So once when you are investor ready, where you should go, to whom you should talk to. So what are the different business models actually? And especially I would like to focus on the difference between VCs and angels, because a lot of people have this, let's say, early dilemma, whom we should contact. Should we go to VCs or angel investors? So let's hear directly from them how you can really, let's say, decide what is better for you and to understand very well the differences in expectations and business model which is behind these two different investor styles. So I would like to hear what is the let's say, first VC structural expectations and what is their logic behind the portfolio. And for that, I would like to hear Mera. Thank you very much for joining from London, Mera.
No problem. Thank you for having me, Mariana. I'll give a quick recap and overview of what a VC expectation is. You may have heard this before, but essentially VCs raise their funding from other investors. So therefore, they need to generate a return to these investors during the life cycle of their fund, which is typically around 10 years. So that means that for say a 50 million fund, a VC will normally target returning 3 times that amount to their investors. So around 150 million, if you take this example. But actually, for that 50 million, they're not going to use that whole allocation for purely new investments. Actually, only about, say, 30 to 50% of that, they're going to invest as initial investments into companies. and the rest of the kind of 50 to 70% of their fund, they will hold back and invest in follow-on rounds into the companies that they think are going to be the real winners and are going to generate the returns to get them to that 150 million mark. And by winners, a VC would typically expect, say, around 1 or 2 of their portfolio companies to be fund returners. So what that means in this example is that 1 or 2 of the companies in their fund of, say, 20 to 30 companies, they want to be generating 50 million in returns. And maybe another 30% of those companies might generate maybe 1 to 5 times the money that VC originally invested in. And actually, VCs expect that the rest of the companies in their portfolio will fail. That means that actually VCs are really looking for a company, or when they're assessing a company, they're looking to see, are you going to be that fund returner for me? And are you going to be able to do that within my life cycle? So say at the point that they're speaking to you in the next 2 to 7 years. And as Lisa mentioned earlier, that means they're going to need you to be operating in a market that is big enough to enable that to happen. So the main things I want to get across from this is that actually it's really important to meet a VC when they're earlier on in their fund life cycle, within, say, the first 1 to 4 years. Because if you meet them at the middle or the end, they're not really going to be looking for new investments, unless, of course, they're fundraising for their next round. The other point to note is that VCs want a really diverse portfolio because they're trying to diversify their risk. So they want to invest across different stages, across different sectors, across different geographies, depending on what their thesis is. So actually, if you are a direct competitor to one of their portfolio companies, they're really unlikely to be able to invest in you. And then the final thing is that, as Lisa mentioned earlier, VCs are really looking for fast growth outlier companies. So that means that VC funding is really great for those companies who are really able to scale quickly. But even if you're building a really great business, if you're not really fitting into that model, VC might not be the right money for you. But there's actually lots of different types of funding out there.
Thank you very much. This is really great overview. Thank you. And now when we already heard the essential of VC business model, I would like to switch immediately to angels to understand what is the difference, that you can immediately contrast those two views. And what is also interesting for this community here, that is that very often it is said that female startups and founders are more likely at the beginning to contact angels, and that is usually relational based, because they can more easily create bonds and deeper relation with angels. So let's hear directly from angel investor if this is true, and how is angel business model working. Damian, could you please give us a little bit more info on this?
Yeah, thank you very much. I was very interested to hear from Mira how the VCs operate, and I'm an angel investor, a small angel investor, and we operate quite differently. So the main difference is yes, I do also have a portfolio view, but I invest my own money. I'm not investing other people's money which have expectation on a specific return and risk on return rate. I invest with a passion into a company and in a team. I believe they can build up a business, they can create jobs, and I'm in for the long run. So I heard 10 years, so my scope, my horizon is also around 7 to 15 years. And I will do, like Mira said, a first initial investment, and then there are other investment rounds where we top up and continue to contribute. But in essence, I have much less a portfolio view, much less risk return view as a VC, but rather more I'm investing in a team, in people, in a product, in a business I believe has can scale up, can grow. And from that point of view, I'm investing in people and not in a business. And that means as an angel investor, I want to build a partnership with the startups. I also want to have some seat in an advisory board or in a board. And I want to bring in my network, bring in added value, help the team to grow, and have a joint success and jointly celebrate the success. And if there are deterioration and deviation from the objectives, I want to bring in expertise to help the team to going back on track. So it's really a partnership. It's a relationship between the angel investor and the startup team, and on the long run.
Yes, thank you
So
very
that's
much.
kind of like the mindset I bring in, because I invest my own money, not
Yes.
somebody else's money, where I need to deliver results versus I need to deliver results on my own portfolio and on my own money. So it's very different than a VC, a typical VC.
Thank you, thank you. So it's really much more personal and very, very, very different, let's say, from VC business model. Thank you very much. On another side, it is very interesting to understand how it's working if the startup would like to have the both investments on the investment types on the board, let's say, and to have VC money and as well angels investors on board. So Lisa, could you give us some examples and share case of some blended model of investment between combination of VCs and angels? Is there some way to support diversity like that, maybe? What do you think?
So I would say all of my investments when I was an institutional investor at Nesta, all had both angels and institutional. When I say institutional funds, I mean what Mira was explaining. VC funds where we have third-party investors who've invested in our fund and we're investing their money professionally on behalf of those, whether they're pension funds or foundations, etc. So it's a professionalized, regulated often activity. Whereas what Damien was explaining, he's an individual and he's writing a check, which he can make all the decisions. He can decide tomorrow I'm going to write the check, whereas we have to go through a governance process, investment committees, to checks and balances that the decisions we're making are in line with what our ultimate investors, the big institutions, expect and want. So that's one thing I'd say. But having said that, it's especially in the early stages of a business, is very common to have both angels and institutional funds on the cap table. But there is a kind of transition. So maybe the board will change, the valuation may change, and similarly, as a company grows and wants to raise more funds in the future, as an early, say we're a seed investor, at Series B, maybe we will come off the board and the Series B investor will come on the board. So the governance changes as the company matures and the funding mix changes. On valuation, in the UK, we have some tax incentives to invest in early stage high risk companies, which only individuals can claim. I'm talking about what's called the Enterprise Investment Scheme, EIS, where if you're a UK income tax payer and you want to make an angel investment into a company, you can get a tax rebate, so you can claim it back against your income tax bill, which is very attractive. And even if the company fails, there is a financial incentive around your tax bill. So it makes a lot of sense to use that tax advantage as an individual. So that means that you're making an investment into a company and you're getting a tax benefit. Therefore, you might not be that worried about whether the valuation is 10 or 20 or 30. But as a fund investor, we don't get those tax benefits. And so we are very focused on our entry valuation, the price we're paying to take a share of the company. Because as Mira was explaining, we know we want to 3x, 5x, 10x that on the exit. So we are much more sensitive to valuation in some circumstances if the individual angel investors are getting certain other benefits to sweeten their deal. And then on what funds bring, as a fund investor, we want to also add value, as Damien was talking about. We will support founders with our networks, whether that's for talent, whether that's customers, whether that's, for example, at Nesta, we were very linked to government and we were investing in companies where public policy was quite a key driver of the market and the business within that market. And we could help our founders navigate that and introduce them to government and those who are making policy.
Thank you very much. Thank you. Now it would be interesting to hear some examples of, for example, how to match the investor type to the innovation stage. And I would give a floor to Dominic, as he has a lot of years of experience in different stages of investment. So let's hear your angle.
Yeah, well, thank you. As you know, there's different types of investors suited to those different types and stages of innovation. And that all depends on what is their risk appetite, their time horizon, and their own value add capacity. Now, just one essential thing here is the right investor at the wrong stage can destroy a great innovation. So timing is important for everybody, the founder and the funder. Now, if you're at what I always hear people say, oh, you're only at the PowerPoint stage, your ideation stage, you're only there with your concept, then ideally you should go and see visionary angels like Damien, or perhaps look for grants, public innovation grants or research endowments. But before you do that, go and speak to family and friends. I mean, there's always a pro and con there, because family may have its little savings and they feel sorry for you and they start putting their savings and the family goes bust. But, everything needs balance. Then you move to the validation stage, the prototype stage, right? There you're looking at amounts of about between $100,000 and $500,000 or euro. That's for pre-seed VCs and foundations. If you go then to the early growth stage, the market entry stage, you're looking there at perhaps $1 million to $5 million. Those are the early VCs or the development finance institutions, right? And then if you start scaling, you're looking at expansion, you're looking at 5 to 50 million. Now we're talking about growth equity, strategic Series B and C investments, and then you reach the maturity stage or the exit stage. Now you can be looking at far larger amounts. You're looking at private equity, institutional, sovereign funds, etc. So everything depends on the stage, and don't go over hasted. Don't try and go faster than you can run. That's not gonna work. So thank you.
Thank you very much. Thank you for this really, really wise and useful pieces of advice. I hope that people are taking notes. now when we understand, let's say, the basic difference between the different investment models between angel investors and VCs, now there is a set of questions related to one topic which was quite interested and gave a lot of questions around, and that is how to find and how to approach to the right investor. So where should founders start when considering approaching investors if they have never done it before? This is really the question for a lot of you. And I would start with, let's say, with the tactical outreach. So how to make, let's say, warm intros, what is the difference between cold emails, how you could approach, what you should do, and how is that perceived from the eyes of the investor. So let's give a stage to Lisa. Can you give us some overview and tips and tricks in this direction?
Sure. So first, pull together your pitch, which would be a deck, slides, and there are plenty of templates online. But also, most importantly, your elevator pitch. So what is it in 2 minutes? How do you explain your business, your proposition, your vision, and all the things we've been talking about here? How do you pull out the most important things and really get people to kind of sit up and listen? Why do they want to continue the conversation with you? So getting that really crisp 2-minute, 3-minute pitch is absolutely essential. The pitch deck itself is important, but be prepared. Investors are going to flick through it. Maybe they'll find certainly less than 5 minutes to look through it, but you will have probably spent hours and days and weeks perfecting it. This comes back to what Dominique was saying about perfect being the enemy of the good. But the pitch deck needs to look polished and impressive. But most importantly is what you say and how you present it and how you then have the conversation and ooze credibility, as we've all been saying. And then I would go to friends and family first. You want a safe space to practice and to refine and polish your pitch and get feedback. So whether or not you want to take money from friends and family, that's a different question, different decision. But finding people who you think can give you really honest feedback and know what investors are looking for, they are worth their weight in gold. And building on that, there are quite a few VCs and other organizations who offer what they call founder office hours. So I have for a number of years participated in Playfair Capital's Female Founders Office Hours, and lots of people are doing this now. What they want to offer is an open door to all founders, any founders, to have an off-the-record conversation, get advice, whatever question you want. These investors are there to help and support you. So look up where are the founder office hours in your area around the theme of the business that you're building and sign up. Typically, it's a few hours and you'll get assigned maybe 1, 2, 3 investors. It's a bit like speed dating. But in 15 minutes, you can cover a lot of ground. And I always say to the founders I talk to, the floor is yours. Ask me anything, whatever you want. I will try my best to help. So it's really a helpful resource. There are also lots of free events and meetups in different cities, in different regions. So take advantage of those, go build your network. So all of that is kind of warm leads. Then there is the cold outreach, which I would suggest you do once you've got some warm leads and you've had some feedback. there are resources out there like there's something called Open VC, which is a free resource of over 9,000 investors, angel networks, VCs of different stages all over the world. And you put in your criteria and it will give you a list of VCs. So you can start building a target list. And your target list needs to be really long, like 50 minimum, probably a few hundred. And then you can start, you can start whittling down to really target the best fit. And then you can also look at your LinkedIn contacts and see if anyone on your LinkedIn network has contacts in any of these investors. Then, ask for intros, be bold. And then finally, what I would say is if you are, whether it's cold outreach or warm outreach, if you get a knockback, if the answer is no, ask for feedback. And if the feedback is something you think sounds a bit generic, ask again for specific feedback. But the key is not to be defensive and not to challenge the response, but to say, I would like to have the feedback so I can inform how I talk about this, how I shape my business as I talk to other people. And most people want to help. They just don't want to be challenged.
Yes, yes. Thank you very much. This is, I think, really useful pieces of advice. And furthermore, since we are focused more on the female community, I wanted to ask Mera about advices for female founders when they're starting to look for investments. What would you advise to them? So what do you think could be recommended?
Thanks, Mariana. And really echoing what Lisa said about building your network and building your community. And I think there's actually quite a lot of good gender-focused communities and accelerators out there that will be really, really helpful for you to join. A lot of these networks and communities also they don't have membership fees. They're completely free to join, and so there's no harm in being part of them. So there's a few different things. So there's things called gender smart accelerators. So in the UK, we have, for example, Barclays Eagle Labs have a female founders accelerator. There's also a initiative called Female Founders Rise, who I think the founder is London-based, but I think actually operates across Europe. Who also does a fundraising accelerator. And programs like this help you refine your pitching, help you with your sales pitch, help you with your investor pitch, go through all sorts of different masterclasses to really help you get that kind of investor ready. But beyond that, actually, once you've kind of graduated a program, you're plugged into a network of peers, of mentors, advisors, who you can kind of chat to and get advice from, get connections from. And quite often these programs will do demo days where they'll bring in investors and you can pitch to them. And so already immediately you have access to 10 more investors than you did before you did the program. And so that, again, it's just really great for building your name, your brand, your awareness.
Yes.
The other kind of things there's loads of kind of community groups who help female founders who are maybe underrepresented. So you have things like the Tech Bros, which are a community for female founders who are doing deep tech businesses. You have Bay HQ in the UK who are targeting kind of entrepreneurs of an Asian background and things like that. So it's really worth looking them up. And if you don't have any in the geography that you're operating in, consider building your own network because people will come once they hear about it. And the final thing I wanted to highlight is that there are actually quite a few female-focused funds and angel investor groups. So there's the Borski Fund in the Netherlands. There is a couple of angel groups called Hermesa and Alma Angels. And if you go to these kind of funds and angel groups, there's a higher chance that you might get funded because of the lens at which they're looking at new investments in. And if they're not right for you from an investment point of view, they will quite often know people that you should go talk to. So that's the other thing. Whenever you speak to someone, ask them who else you should be speaking to.
Thank you very much. Continue opening the door, let's say.
Yeah.
Yeah, thank you. And now when we, let's say, have a first idea whom we should approach as a founder, now very interesting would be to know what is actually catching the attention of the investors, how to get that interest in them, and what are really these subtle details. So Damian, could you tell us a little bit about it? Damian, you're muted, excuse me.
Yeah, thank you. I learned a lot from Mera and Lisa about how to approach the different organizations who can help founders. So took good note of that. Now about angel investors and what we're looking for. I can talk about what my group is doing. I'm part of an angel network in Switzerland, and what grabs our attention. So typically we have 3 to 4 investment rounds per year. We invest roughly about 10 to 30 millions per year on startups as a group. And when we open for the investment rounds, we get typically around 40 to 50 startups which want to pitch with us. So how do we select them? We look at the pitch, and as I think it was Dominic who mentioned that clarity is key, not over-designed. Clarity is key, good business model, a good plan, a good strong team, a convincing pitch. That's the first thing we look at. It doesn't need to be perfect, as mentioned earlier by Dominic, and I think Lisa or Mera as well. And then we try to find a so-called mentor in our angel network. A mentor is a person who has some affinity to the business they want to invest. For example, if it's a medtech, we have a couple of doctors, pharmaceutics, fintech, medtech investors, and they will look very closely at the pitch. And maybe if they like the idea, they call up these founders and offer them mentorship to polish the pitch and to jointly sharpen the pitch and then present it to the angel network. So that's the way how we get there. So in essence, what we are looking for is if there is a pitch, we look and try to match with an angel investor who potentially is interested because he has expertise, he has seen similar companies, he's invested in similar companies, or he just finds the team is very convincing with the experience, and then we match them as a mentor to these founders to polish the pitch and bring it to the network. Key is when you come to the rooster is that you have already a very strong conviction and a clarity on what you want to achieve, what do you need. Don't oversell, because overselling doesn't resonate with angel investors. Be authentic in the pitch, be realistic in the pitch, and be a little bit humble. Not everybody is a Steve Jobs who will conquer the world in 10 years. Bring a realistic business idea which catches the eye of an expert in the field who then can become your mentor and an angel investor.
Thank you very much.
The way how we work, and then out of this rooster of 40, we pick 8 companies which then present in front of the angel network, 6 to 8 companies, and the mentor is sponsoring it, supporting the pitch, and then the angel investor decide whether they want to fund the founders or not. And typically out of 8, we found 1 or 2 companies which then are doing the pitch. So if I sum this up, from the 160 pitches we typically review on an annual basis, we end up with something around 10 to 12 investments.
Thank you very much. So now we are actually quite running out of time, unfortunately, and we had so many more things to share with you. So I think, Zana, that we will need a follow-up event where we can continue discussing and giving tips about pitch deck and red flags on both sides, etc. So I think that would be interesting. And if people would like to have a follow-up with continuation, you can write to Zana or share now in the chat. And now I would just I would thank first to panelists for the questions which you already answered. And Maya, could you please choose some of the interesting questions which are posted by the guests. If we could maybe separate one or two to still answer, and then Zana would have the closure.
Yeah, we have many interesting questions. Unfortunately, not enough time. Some of them we already covered, but let's say this one is interesting. So what's the one thing early startups underestimate that would make your investment decision much easier? So is there something that startups can do as a quick fix, or that they are not aware of something what they can do? Perhaps that we can, yeah, we can, okay.
Can I jump in?
Of course.
One, it's not, I would say time. People underestimate the time it's going to take to raise funding. So at least 6 months from start to finish, at least, probably more. And when a startup comes to us with a brilliant proposition, but we're going to run out of cash in 2 weeks' time, that's really hard. That's really hard because it doesn't give us time to do the work we'd like to do, to really build conviction and also to get to know each other. You need to get to know your investors as much as your investors need to get to know you. So I would say make sure that you build in sufficient lead time of 6 months plus to raise your investment round. Maybe slightly different with angels, but even so, it's not going to happen overnight.
Thank you very much.
If I may add on that, yeah, 6 months also with angel investors. For us, it takes 6 to 8 months until the founding round is actually really closed. And it's all about getting to know the team, etc., etc. You mentioned that, Lisa. Another thing which founders also underestimate is that, as we talked about the clarity of the pitch, I see a lot of pitches where they want to conquer the world within 3 years, completely unrealistic business cases, over optimistic business plans. And if you don't believe that the people can deliver on that, it's very tough to get investors to buy the story. So rather be realistic, under optimistic, that creates much better trust with potential investors to find funding than being over optimistic and to be polished, to be over smart and over polished and over ambitious. Be ambitious, but realistic.
Can I just jump in on that? I totally agree with you 100%. But one thing I would say, particularly with female founders, is that you need to tread the line between lacking credibility because you're talking such big numbers and the hockey stick is amazing, but totally unbelievable, and retaining a sense of ambition. Because I think with female founders, there is the danger of being too conservative and saying, I really think, because you're going to put out a case that you know you can deliver. But then the guy next door is going to put out this unbelievably huge case and say, I'm going to conquer the world. And investors are stuck between, well, he's going to conquer the world, but really, but you know, there's a 5% chance he might conquer the world. And a very solid female founder who's going to absolutely deliver, but could she have delivered more? So it's finding that point which doesn't lose ambition, but isn't crazy and is credible.
Spot on.
Yeah, I fully agree with all of that. At the end of the day, it's a game of poker chess. You need to see the individual knowing how to at first position themselves as you would position yourself on a chessboard, and then to show discipline, which is a very important aspect, where patience comes in, and that patience means that they need to be extremely watchful And then when the opportunities arise, they must hit hard and fast. Now, that is all related to attitude. So we're talking about attitude, talking about discipline, integrity. You have to be honest with yourself. Don't fool yourself. Don't go and fool others. Work on yourself. That's extremely important. And of course, if you want success, you have to make the effort and you have to respect everybody, all stakeholders, not just family and friends or the investor or no, everybody. If you don't mind, I'd like to close with a little exercise I did. And anybody who can write very fast, I'm going to give you 16 words, and they all have a common letter. But I want to see, when I invest, curiosity, a high CQ. I want to see charisma. I want to see charm, not stressed, pure charm. I want to see courage. I want to see, of course, competency. I want to see credibility, composure, clarity, we mentioned it, consistency, confidence, collaboration, connectivity, a corridor which allows energy and everything else to be channeled, conviction, and you have to be coachable. You have to listen before you speak, and you have to learn all the time. And those are my closing words. Thank you very much.
Thank you very much. This was really lovely. Thank you.
Thank you
Zana,
all. Thank you
could you
all. I
tell us-
really
Thank you.
amazing session. Thanks a lot. We have received some questions prior to the session. I hope we have tried to answer them at our best ability. So we have received some questions now. I think we answered all. If not, Maya will be looking into it and will be answering via the email. I have mentioned that we are preparing, and some of us are here who will be involved in that longer workshop because we feel it's needed. We gave, I think, a catchy title, The Female Founders Fast Track, Matrix, Money, and Mastery. Please email Maya if you're interested to find out when and how and what. And some of you will be delivering, some of you will be guest speakers, some of you will join us as participants. But my thank you really goes to all of you, Mariana, Lisa, Mira, Damian, and Dominic, because I know how much effort, and Maya, of course, you have put in to prepare and more importantly, to deliver value to our audience. And we will be sharing it on our network for other colleagues who could not join. And thank you so much, and wishing you a pleasant evening. Thank you.
Thank you.
Thank you.
Thank you.
Thank you.
Bye-bye.
Thank you. All the best.
Bye.
Bye-bye.